Everyone at our company knows how to use it as a verb. I wrote 26 rules of behavior, and we call these rules RockSteps.
If you want to build a business and a successful business and one that lasts a long time, it's like you so clearly have to define the company culture or the core values.
We do something that is different than anybody in the country. So we go in when we buy a property and we engage with the business leaders in the market. And we get business leaders to be our partner on the deal.
Good morning, everybody. We got a podcast here from the Commercial Real Estate Blueprint podcast. We have Andy Weiner. He's president of RockStep Capital based in Houston, Texas. He has built over 10 million square feet of retail shopping centers. They currently own about 5 million in square feet and shopping centers across the Southeast. Again, he's based in Houston, Texas. Andy, we really appreciate your time. We were talking right before the podcast. It's so good to have another operator back on here, somebody that is in the weeds every day of owning amazing shopping centers across the Southeast. Andy, thank you for your time, and we look forward to getting into this podcast. So tell me a little bit, for those that don't know you, what your background is, what got you into commercial real estate. Tell us all about Andy Weiner.
You got it. Well, hey, thank you very much for the opportunity to be on your podcast.
Absolutely.
One correction. We're in 11 states. We currently have property in 11 states. Basically, not just Southeast. We go from Minnesota down to Texas and from Arizona down to Virginia. So
Gotcha.
Kind of an upside down T. Anyway, excited to be here. My background is that my grandfather started a chain of clothing stores here in Houston with our family name, Weiner's Stores. And we ended up with over 150 stores, the size of a TJ Maxx, 20,000 square foot, men's, women's, kids, shoes, clothing. And I ran the operations for the company. So I ran store operations, all of the stores. I ran real estate, logistics, finance, HR. Basically, I'm a student of retail. I love retail. I understand retail. And then almost 30 years ago, I started investing in shopping centers here in Houston and have been doing that since then. And we have built or acquired over 10 million square feet of centers. We are a vertically integrated company. We've got about 100 employees, and it's just a fun business, and it's a great time to be in the shopping center sector.
Yeah, that's amazing. 150 stores operating pretty much everything part of the company. That's a ton of stuff that you had to take on and work on, and that's a lot. So tell us about kind of like why RockStep Capital and like the transition from kind of being an owner operator a little bit into more of a capital operations.
Yeah, so our company was competing against Walmart. We had been in business 75 years, and we had some family issues, and we were competing with Walmart, and we did not survive. Okay, we went out of business. I actually have a YouTube channel called the Shopping Center Channel, and on there I've got a video about why Walmart is so powerful and how it killed family businesses like ours. So people, if they want to, they go onto the Shopping Center Channel and they can see that video. And so because I knew retail and because I knew shopping centers, it was a natural transition to go into shopping center investment. And then I started the company. The company's name is called RockStep Capital. RockStep is not a word that most people know. It's not a word in the dictionary, but if you're a dancer, you would know the word because it is a dance move. And I like swing era music from the 1950s, 1940s. It's called big band. Frank Sinatra, Ella Fitzgerald. I don't know if you guys know that genre, that time period, but when you do swing dancing or ballroom dancing with your partner and you switch directions on count 7 and 8, you rock step. Okay, so it's 1, 2, 3, 1, 2, 3, rock step. Or if you were taking dance lessons, the teacher might have said ball pivot change. Okay, so your wedding, I don't know if you guys are married or not, but at your wedding you might have been rock stepping when you were dancing with your partner. So we use it as a metaphor to be nimble, agile, responsive, to listen to the music in our industry. And Graham, we got a problem. We need a rock step. Or Jess, we got a great opportunity, guys. Let's RockStep. So everyone at our company knows how to use it as a verb. Then I wrote 26 rules of behavior, 26 very detailed rules of behavior and we call these rules rock steps. Okay. And we have this ritual that we call the rock step of the week. And every week we have that rock step. This week, rock step number 23. And here's all 26 rules here. And this week it is don't be a jerk. And so the whole company at 10 o'clock on Monday gets on a Teams call and we talk about the rock step of the week, and somebody writes an essay. What does it mean to don't be a jerk? We don't allow jerks at our company. Okay. And we talk about it, and then they call at random 2 to 3 people. Hey, Graham, what does it mean to you to don't be a jerk? Okay. We have that discussion. And then next week we go to rock step 24, be a careful steward of our assets. And we do this twice a year. We rotate, and we've done it for 10 years. And this is required behavior for everybody at RockStep. We are not perfect, but it's required to build a team, to resolve conflict, to build trust. And it's required behavior with our investors, our tenants, our communities, our lenders, our service providers. And there is nothing more important than this at our company. It's emotional to the mat, tears. Jess, if you were going to interview at our company for a job, you go to our website, and you go to the RockStep way, you would study these, and you have to, part of your interview is, what are your favorite 3 and why? What most resonates with you and why? And what's more challenging for you guys and why? And I'll share with you my 3 that most resonate with me is rock step number 1, do the right thing always. We're in the investment business, so sometimes it's not always clear how do you do something. You got to stop and say, okay, guys, what's the right thing to do? Another one of my favorites is actually rock step number 2, keep family first. You have to take care of your family first, then you take care of RockStep. And then another one of my favorites is RockStep number 5, be punctual. On time is 5 minutes early, and if you're on time, you're late. It's about respect. It's about courtesy. It's about paying your bills on time. More challenging for me, RockStep number 6, be responsive. Hard to keep up. Too much is coming at me. RockStep number 9, listen generously. Key operating word is generously. I am a bad listener. I am impatient. I interrupt. My wife would tell you I'm a terrible listener. I actually think women probably listen better than men. Definitely, it's an opportunity for me to improve. And another one of my challenges is the very last rock step 26, keep things fun. My wife says, Andy, you take the fun out of fun. Okay. I'm very serious. Kind of very business-like. On the inside, guys, I'm very happy. I just want you guys to know that. My wife, on the other hand, she's giddy, happy on the outside, but a little bit kind of like a stress ball on the inside. So we match perfectly. So I spend a little time on this because there is nothing more important. It is the core of who we are. And we've got people from Blackstone and Brookfield and CBL who, part of the reason I believe they're here at this company is that we really try to live by these rules. So now you know who we are.
That's so cool. I think something we've learned interviewing a bunch of people, also being at City Plat, is that like if you want to build a business and a successful business and one that lasts a long time, is like you so clearly have to define the company culture and, or the core values. And, a lot of people have 5 to 7 core values, maybe 3 to 7. You guys got 26, which is awesome. And you just have those so clearly defined. And what it does is it attracts the right people. Mm-hmm. Because if someone comes along to your company and they see all those core values and they're like, I don't really vibe with this, it's almost like an automatic filter.
Yeah. And I would tell you that there's a difference between core values and behavior. So what I've tried to define are specific behaviors. Okay. Be punctual, on time. We start our meetings on time, not 1 second late. And it's, everything, bring it every day, provide solutions. That's another rock step number 18. And we talk about the specific behavior of each of these rock steps. And then it's that ritual of the rock step of the week, and the language we use is used countless times every day.
That's incredible.
Yeah.
That's incredible. I had a question. It's kind of like jumping right into the retail
Sure.
aspect, but it made me think about it with Walmart. So like we're brokers, right? So me and Jesse broker deals, but we also are investors. And when we broker retail deals, a lot of the time buyers they don't want to buy a shadow center to Walmart. So like sometimes, they'll sell off these 10, 20,000 square foot shopping centers that are directly beside Walmart. And they're like, that's a no, we stay away from that. So I'm curious your thoughts on that, since you mentioned, Walmart being a monster.
I know Walmart very, very well. Shadow anchored Walmart is a great business. And if those people shy away from it, they're missing an opportunity. It's a great business. Walmart does on average $100 million a store. Let's call their average transaction $25 a transaction. Let's do a calculation of 100 million divided by 25 divided by 305. That's 10,900 shoppers a day coming to that location.
Jeez.
There is no retailer that has that level of traffic anywhere. So it's a good business. There are people who specialize in shadow Walmart centers. And again, the word shadow can be used for shadow Target or shadow Kroger or shadow Publix, whatever it is. The shadow business is not a bad business. If it's grocery or if it's Target, Walmart or Costco, not a bad real estate strategy.
Yeah. I thought it was interesting because I kind of have the same thoughts, like driving a lot of traffic. And if you're selling like, food or something like, right. So there's Walmart near my house and they have a hibachi restaurant. It's like Walmart's not selling hibachi or a wing restaurant or hair cutters or whatever.
10,900 people a day.
Yeah.
That's a lot.
That's wild. That's wild. So I'm curious, tell us about you guys' purchasing requirements and then the reasoning behind it. Because
Sure.
I'm sure you got that dialed for your buy box and all the reasoning and stuff.
Yeah. So we'll talk. Let's make sure we talk about why retail, and we'll get to that. But we buy two type of shopping centers. We buy open air centers they're either called power centers or neighborhood centers. Sometimes they'll have a grocery store, sometimes not. But they're generally 100 to 500,000, 100 to 300,000 square feet. Okay, it's open air. TJ Maxx, Ross, Five Below, those kind of tenants called open air. The second is we buy enclosed malls. An enclosed mall is kind of a weird space. It's a very difficult space, but you can get really good deals. And we buy these shopping centers in a defined geography. We call them hometown. This is secondary, tertiary markets under 1 million, above 100,000 in population that has some growth driver. We call it an essential driver, something driving population growth. What is it? It's a major university. It's a military base. It's a growing hospital system. It's a Fortune 1000 company. It's tourism, strong tourism, something driving tourism. So something driving population growth. So you want a high quality of life, low cost of living, low crime, an engaged civic community. And particularly, we own 14 malls. When we buy a mall, it's usually the only game in town, not always, but usually. And we do something that is different than anybody in the country. We believe that we know how to run a mall. We know how to lease it, budget, all that kind of stuff, manage it. But there's aspects to how that mall performs that are not just pure management and leasing. And so we go in when we buy a property and we engage with the business leaders in the market. And we get business leaders to be our partners on the deal. So we'll get local business leaders to be our local partners, our local investors as LP investors. And as a result, we're able to improve performance or reduce risk, whichever way you want to call it. Why? It's a three-part strategy. Number one, they help with things like incentive, property taxes, entitlements, consents, even leasing ideas, because they are on the board of the community college or the hospital district or economic development. So they just know. Okay. Number two, lending in the enclosed mall space is tricky. And often our local investors own the local bank or they're on the boards of the local bank. So we get community bank lending that is very flexible and accretive to value. And third, when we sell a property in 5 or 6 years, we're opening a new channel for an exit because our local investors often could be the owners. They're very wealthy. They like to own real estate. They like to own in their market. And if they've lived with that asset for 5 or 6 years, they've gotten comfortable with it. They could manage it themselves. We could manage it, or they could do third party. So that is part of our secret sauce. And so we buy open air, we buy enclosed malls. Open air is typically in that 8.5 cap range. Enclosed malls is 13 to 17 cap typically.
Wow.
So it's very high yield place. So that's the kind of product we do. That's the geography we do. And again, our strategy is all about, local partners.
I'm curious if you have always done malls or if that was something that you rock stepped and changed after COVID to take advantage of an opportunity.
I'm impressed that you use that as a verb, Jess. Okay. Okay. Is it Jess or Jesse?
Jesse. Yeah.
Jesse, excuse me. I'm very impressed. That was good. You're listening. I usually don't listen. You're listening. That's good. So it actually started in the great financial crash, so the GFC of 2008. We were doing a lot of Tractor Supply deals in small towns. That's kind of how I started to work in small towns. And in 2008, you couldn't get deals done anywhere. So we started working in a city called Vicksburg, Mississippi on a mall. And we bought a mall from a company called CBL with local investors, local lender. And that's how we started that process. And I mean, malls are probably the trickiest asset in commercial real estate to manage. They're very, very complex. We've learned a lot. We made some mistakes, but we've gotten better and better. And it's been a lot of fun.
That's so cool. Oh, go ahead, Jesse.
Well, I was just going to say, I don't want to speed past this, but you said you made some mistakes. I think that a lot of people listen to podcasts. They hear people talking, oh, we've done X, Y, Z, but they don't hear about mistakes. They don't hear about how you stuck with it. You didn't make a mistake and like, okay, we're never going to do a mall again. You're still open to buying malls because you've, at this point, I won't say perfected, but you've gotten a lot better at it. I think a lot of young operators need to hear that it's okay to make mistakes. You're probably going to make mistakes no matter what anyways, and to keep just pushing through that asset class and not just give up.
We made many mistakes, but I would say one of the biggest ones is that we entered some markets, and this was in the legacy era, call it pre-2020, where we went into markets that in today's world, we've defined hometowns as these growth markets. We went into several markets that didn't grow, and they were actually declining in population. They were simply too small. And as a result, when we lost a tenant, there was no ability to backfill that tenant. And as a result, the property underperformed. So we've had to redefine the type of markets we go into and the criteria. We've gotten better. Again, not perfect, but again, you've got to be a learning organization. And you learn from pain.
Yeah. I have a question pertaining to that. So, you had, it sounds like based on your track record and how long you've been doing it, I just wanted to compliment you that it sounds like you guys have an absolutely dialed buy box. A lot of people still don't have it as clearly defined as you do. And I feel like that's a secret weapon in itself that you were like, you said multiple things like between 100 and 500,000, and you labeled all these different things that are like, that makes it when a deal comes up that checks your box, like it makes it very obvious and clear. So I think that's really cool. And that's important for people to hear that you should have a very clear defined buy box. Me and Jesse have been working on that. And as you buy more deals, the better you get at that. And we're still working on fully refining ours, but it's also makes you look like you know what you're doing when you speak to brokers and you say, I do this, 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 and this. This is where I buy. Not just, people who say, we've talked about before, people who just say, I want a good deal. But I'm curious if you consider a driver, like I want to take where I'm at, for example. So I'm from the Raleigh-Durham area. We just bought a house like 20 minutes outside of Durham in a different market, and a lot of people are moving there. I'm not sure if it's got some of the things you mentioned. I know it has over 100,000 people. I think it's like 188,000.
Are you talking about Raleigh-Durham or where you live now?
Where I live now, it's like
what city is it?
It's called Mebane. So like Mebane, but it's grouped with like Burlington, Mebane.
Yeah. So the answer is it would qualify, and I'll tell you why. Okay. So first of all, Raleigh-Durham would qualify. But it's on Raleigh-Durham's together is probably more than 1 million. But
sure.
If you take a look at certain of the big cities, whether it's Houston, Dallas, Nashville, Raleigh-Durham, Charlotte, what you find is that the cost of living has skyrocketed. Okay. And that if you go within a 90-minute drive radius of those markets, you'll find low cost of living, high quality of life communities. But you can still go in to hit the airport or go in to see the major league sports team or go in if you need to have world-class hospital. Okay.
Mhm.
And so you take that 90-minute radius outside of these markets where you can get a home for 300,000. Okay. And you can't do that in Charlotte. You can't do it. And I mean, you can't, you got to go. And so you're seeing that growth. And in those areas, those are very attractive markets. And so Graham, look for opportunities for us. You think I'm kidding?
No, 100%.
I'm
And
not
that
kidding. Okay.
yeah, for sure.
So we track the growth retailers, and we'll get into why retail. Where are they growing? And in particular, where are they growing in hometown?
Yeah.
And we track those opportunities and we try to get ahead of those opportunities to create investment opportunities in our sector.
Yeah. So that was kind of like you answered my question basically perfectly. The question was kind of like, can the driver be that people are getting pushed out of these? Like, for example, we could afford a house in Raleigh, Durham,
Sure.
but we got double the house for
Absolutely.
moving 20 minutes outside. So it's like, is that a driver?
It is a real phenomenon. That 90-minute drive radius outside of Raleigh, Durham, and Atlanta. I mean, all these massive cities. It's what's happening.
Yeah.
Mm-hmm.
Better
That's
quality of life, lower crime, more engaged civic community. It's a hometown. Absolutely.
That's what I figured. That's
Find
cool.
us a deal.
I thought of one while we were talking. I'll send it to you afterwards, actually. So
I'm serious.
yeah, for sure.
Okay.
Absolutely.
So let's talk a little bit about why retail. Is that
Mhm.
okay?
Absolutely.
Yeah. For
Okay.
sure.
So let's make the case for retail. Retail was out of fashion till about 3 or 4 years ago when you had the big spike in interest rates and you had this spike of construction costs. Okay. And a couple of things happened. Amazon and COVID together killed the weak retailers. They killed them. But those that survived were able to maintain market share against Amazon and even take market share away from Amazon. And their balance sheets are strong. And they're telling Wall Street, okay, we're going to grow because that's the story for Wall Street. So TJ Maxx, we're going to grow at 130 stores a year. Ross, 90 stores a year. Burlington, 110 stores a year. Aldi, 225 stores a year. Five Below, 150 stores a year. And until recently, there's been no new shopping centers being built. So you have all of these companies that are growing per year, and there's dozens of them into an inventory that until now has not been growing. So it makes existing retail more valuable. Okay. Number two, you have positive leverage in our space. Okay. And I want to define positive leverage and negative leverage. So positive leverage is when your cap rate, your yield at acquisition is higher than your interest rate. So you buy a shopping center at an 8 cap, open air center, your debt is at 6.25, 6.5. By adding debt, you're improving the cash flow to your equity because your interest rate is below your cap rate at acquisition. In the mall space, you're buying it at 13 to 15 cap and you're borrowing at 6.5. You have a lot of positive leverage. By adding debt, you throw a lot of cash to your equity. In the multifamily space, particularly in the bigger cities, they're valued at 4 to 4.5 cap. But your debt today, you can get debt at 5, but maybe 5.5, but that's negative leverage. By adding debt, you're hurting your ability to throw cash off to your equity, and you have to have a story of a massive rise in NOI, okay? Let's call it a strategy of prayer to see that your NOI rises, and prayer is not a great strategy in real estate.
Yeah.
So,
no way.
So you've got positive leverage and you've got tremendous demand, and that is a good combo.
Yeah. Do you have a man?
Retail is back in fashion.
Yeah, and I think that's true too. So like City Plat, they also buy retail, but they're looking more for like the neighborhood centers where there's not really a big anchor. They have done a couple anchored centers by like Food Line or something, but for the most part, it's like these smaller units. And their philosophy was like you fill them with people that Amazon can't really replace anyway. It's like a
service-oriented retailer.
Yeah.
Yes. By the way, very good strategy, Grant. Very good.
Yeah, thank you.
Shadow anchor is good. Small strips are good. Unanchored strips. If you're simply buying a center well below replacement cost, good strategy.
That's great. So I have two questions. One is, do you have a minimum spread? Because some people will say like, all right, if interest rates are 6.5, I got to at least be 2 basis points. Like, so, an 8.5 cap is what they're buying at. Or if it's 6.25, they got to be buying at 8.25. Do you have a basis spread? And then now that we've talked a little bit about like we talked a lot about your buy box, the market size, the market factors like that are growing and population and all that stuff. And then also the cap rate range that you go for. But you mentioned something that every investor I know looks at who's like a really good investor is like replacement cost. So if you elaborate on that a little bit, mostly because I had somebody ask me this recently, they're like, well, what is replacement cost nowadays? And that's a hard number to pin down based on market. So if you were to build a retail center nowadays, what is it? Depending on where, $200 a foot, 250, I don't know.
Yeah,
But
I would say
give the audience a little bit more insight on that.
Yeah, the larger centers, the replacement cost and I'll go that first, and we'll talk about spread. So if you're building a 100, 200,000 square foot center, you're at 175 to 200 a foot, not including site work and land. So you might be into it at 225 to 250. So how do you make that work when your retailers like TJ Maxx and Ross will only pay you $17 a foot?
Yeah.
It doesn't work. You either have to have lots of pads and lots of small tenant space, or you need some kind of incentive from the city county. And that's how a lot of deals are getting done. New construction deals are getting done with incentives. In terms of the minimum spread, you're talking about the spread between the cap rate and the interest rate. It depends who the investor is. Our investors are generally more, we target a 15% IRR to our investor, 50% plus. So if you're a core investor, core plus, and you want an 8 or 9% return, you can take a tiny spread. Okay. On an enclosed mall, your spread is 14 cap minus 6, that's 7.5%. It's big. Okay. If you're on open air space, it's 7.5 to 8.5 cap, and the spread is 1 to 2 points. And then the question is, how credible can your strategy be to increase NOI? Okay. So, and that's really, on an enclosed mall, you don't have to increase NOI. You just have to keep NOI stable. Okay. So if NOI is stable at a 14 cap and you lever at 55% at 6.5% interest, the math is pretty simple.
Yeah. Levering at 55 to 60% is pretty crazy too. Is that typically what you guys are doing? Are you putting that much down?
Well, you can't borrow in a mall more than 55% typically. Okay. Oh, wow. For open air, you generally have to lever up because there's a lot of competition to win an open air deal, and you have to get kind of creative on your debt financing to make it work.
Mm-hmm. Yeah, that makes sense. On open air centers, is there a box size that you stay away from? And my part two to that question is on like more of a strip mall center. Is there I've just heard this before where they don't want to have a certain depth because if it's so deep and it's so skinny, it's hard to find a tenant that would work for that amount of space.
Let's start with depth first. Okay. We're buying a mall. You buy cheap. So let's say you buy we're buying one right now that is, 600,000 feet for $30 million. We're buying it at about $55 a foot. So replacement cost is 5 times that. So you're going to end up with, if you have to redevelop part of it, you could end up with some boxes with depth you sometimes don't use. So it's called dead space. Okay, so let's say you take an empty Sears box and you want to chop it into TJ Maxx, Ross. Like the Sears box might be 250 to 300 feet of depth, but the depth you need for a TJ Maxx or Ross is 200 feet. So you have that empty space facing the rear where there might not be any storage opportunity. So it just becomes dead. But because you own your space, your vacancy generally for free, the numbers still work. Okay. So, and then in terms of box size, it's just part of your calculations. If it's too deep, you generally want shallower. Okay. Mm-hmm. Generally want shallower, except you want, in a perfect world, 150, 200 feet of depth for a junior anchor is a good size.
Yeah.
Yeah. I think that's something that will scare some people away is you only have so many tenants that are going to take a 20,000 square foot box of retail, and the smaller is obviously better. But I was just curious your thoughts because it seems you guys work with Tractor Supply, everybody. But those are the ones you named earlier, probably just about all that you can get into a space that size without.
Jesse, I correct you.
Okay.
Correct. When you say scared, boy, can I replace a tenant that's 20,000 feet if it goes empty? Prior to 3 or 4 years ago, you would be scared. Today, you pray that you get a box back. Okay, because you'll have 3 or 4 or 5 people that would backfill it. So when you buy a center, let's say you buy a center and TJ Maxx is in there for $11 a foot, or Barnes and Noble is in there for that range. If they don't renew an option, you have a windfall, because the market value today for a 20,000 square foot box is $17 a foot. Okay, so can you get that lucky? Pennies in a mall pays $2 a foot gross per year. That's less than the triple nets for 30 more years. Okay, so if you got a pennies back at $2 a foot gross, in other words, they have free rent and then some. Okay, you can replace a pennies box with $16 to $18 triple net credit tenant deals all day long. Wow. So your downside is your upside.
Yeah, I feel like I heard a story about I won't name the name, but a big company here who had a pennies at a very big location, and they missed their renewal period, and they had it like an option for like $4, something ridiculous. Since they missed it, they ended up re-signing it, quadruple or something. And so they were like pretty pissed about that. But I mean, obviously the person who owned it was very happy, but Pennies was pissed about it. But I have a question. So as a, operator, like, let's say me and Jesse want to get into retail, which we do, and we want to learn this stuff. How do you look at that from a standpoint of let's say there's 5 years left on the lease. You're going to buy it. There's a box that's 20,000 feet and it's going to go empty. Okay. That's a good thing, right? Like you just said, because you could go to $17 a foot, but are you planning on having a capital reserve for the upfit? Are you offering free rent for the upfit? Okay. How do you plan on that?
Great question. The question is, how do you find or anticipate TI needs during the life of the asset? That's another way of phrasing the question. Yeah. So if you have CMBS debt or insurance company debt, it's very inflexible. If you have bank debt, you have what is called good news lending. Okay. Y'all know what good news lending is? You heard the term?
No.
Okay. So good news lending is when you have an executed lease from a great tenant and you go to your bank and you say, okay, TJ's is wanting to come here. The whole package, TI, legal fees, brokerage fees, $2 million. Will you lend us all $2 million based upon good news, an executed lease with a credit tenant? And the answer is yes. Why? Because you'll improve your debt service coverage, DSC, which is the most important criteria for a lender, and you're going to improve credit quality. So that's the advantage of bank debt. What's the disadvantage of bank debt? Okay, is sometimes it has some recourse to it. So many investors will say, nah, I'll go the non-recourse route. But when you go the non-recourse route with CMBS or insurance companies, you lose flexibility. So kind of a trade-off. Bank is flexible, but they generally want recourse. Not always, but generally, or limited recourse. CMBS debt or insurance company debt is non-recourse.
That's incredible. I didn't know that. That's incredible.
Yeah. So good news lending is most banks are open to good news lending. I mean, do you guys know what debt service coverage is? Do you know what that means?
Of course.
Okay. So that's the most important thing for a lender is NOI divided by debt service on a yearly basis needs to be above 1.25 or 1.5, but they want it stable, if not growing.
Yeah.
So if your good news makes that ratio go up with better credit all day long, lenders will do that all day long.
Plus, you didn't mention another big thing too is that it improves the property's valuation tremendously.
Correct.
Could triple in value or whatever, just based on if you're going from $3 to $17, it's going to massively jump the value of the property.
Absolutely.
Jesse, what was your question?
You put me on the spot now. I forgot it.
My bad. I just thought you were going to ask something. I wasn't trying to.
I want to make sure I cover something before we finish.
Yeah.
If I could. And that is that our goal as a company at RockStep is to be the country's leading educator about investing in shopping centers. So most people don't know anything about shopping centers. So if you go to our website, you go to the education center, we have over 150 articles on everything associated with shopping centers. How do you define a shopping center? How do you define a market? What is co-tenancy? What are exclusive provisions? Everything for education. And then we also have videos. We have the YouTube channel called the Shopping Center channel. That's our channel. And I'm the Shopping Center guy on Instagram. And our goal is to educate investors. So if anybody wants to learn more about this sector, please go to our website, rockstep.com, and go to the education center.
Yeah, that's amazing. It's a great resource for people to use.
I had a question. So, you guys have a great company and you sounds like you work with investors. Like, did you start off immediately taking investors or is that something you grew into? And then how do you typically structure your deals with like, investor returns? You said at
Sure.
15% IRR, but like,
Yeah.
do you
So
have other partners? Is it just you bringing on LP money or how does that work?
Yeah, so I'll walk you through the journey. Before the great financial crash, we did not need third party equity to get deals done. The great financial crash, we started doing syndications deal by deal. We find a deal, we raised 2 million, 5 million, 8 million, 10 million, and that's what we did. But things have changed, particularly in the distressed mall sector, that the time period of acquisition is so fast. It's 3 to 4 weeks from the time you find out about an opportunity till somebody lays eyeballs on it, you underwrite it, you come up with a strategy, and you have to prove to the seller that you have equity in place for you to win the letter of intent. That's a 3 to 4 week cycle. And so we changed our fundraising strategy to move to a fund strategy. RockStep Hometown America Fund 1, which is a collection of hometown open air and enclosed malls in the geography of hometown. We're targeting a 15 to 18% IRR, a 2 times return with a current yield of at least 6%, but the preferred return is 8 to 9% depending upon the investment. It's minimum investment 100,000, and then if you hit 1 million or 5 million, you get a better split in the back end and a better pref. And so it's a closed end fund. So we're moving to a fund model so that the seller knows, hey, RockStep can close because they have committed capital.
That's cool. And then for us, because we're the deal guys, right? Like we want to go out, find deals, put them together, bring in the investors. So
Yep. Yep.
so for you, are you guys like charging acquisition fees, or are you just getting like a portion of the equity, and that's how
Yeah.
you're, quote
So
unquote
basic.
living?
Yeah. So our fee structure is the following. We take a 1.5% acquisition fee. We're vertically integrated. So we do our own property management and leasing, and the fees we charge are the same or less than if we hired third party like CBL or JLL. And then we get a promote on the back end. And the promote is 20% of the profit after investors get their preferred return and all their capital back. If you invest over 5 million, if you invest 100,000 to 1 million, then the split, we get 30% of the back end. Okay. So that's basically the structure.
Got it. So another question, there's obviously a lot of people argue that, it's easier to do bigger deals and that you should move on to do bigger deals. Obviously you need to build your track record and learn and stuff like that. But, we've been playing in the million and less arena. So we'd love to go out and do some bigger deals, but it's obviously scary. It's intimidating. Want to make sure you don't do anything wrong or make mistakes. But like, what's your opinion on, because you just mentioned doing like a $30 million deal. That's huge. That's awesome. So like, what's your opinion on deal size and somebody who's been investing for a little while versus somebody
Look,
who's
if you're going to be the
new?
sponsor, you've got to start off small.
Yep.
Why? It's hard to get a deal done. It's just hard. It's hard to find the right deal with the right time period. It's hard to raise equity. It's hard, guys. It's hard. It's hard to do that. And so that's where you start. You do stuff in your backyard and you keep deals small. If you find bigger deals that are shopping centers in our hometowns, bring them to us and we'll figure out how to work together.
Okay. So for like people listening, basically it's like if you're just starting out or you've been doing it a little while, you got to kind of stay low. And then if you do want to go after a big deal, you want to partner with somebody who can mentor you, guide you through it. And then maybe after you do that a few times, you could go off and do it on your own.
Yeah. And then the
advice.
issue about doing stuff on your own is you've got to get comfortable with putting your balance sheet on the line, because when you start off really small, you kind of have to do a loan guarantee at the bank. It's very, I mean, that's a heavy issue for many people. I mean, you lose your car, you lose your house. I mean, like, you could, serious stuff.
For sure.
Okay. So it's not for the faint of heart. So, anyway, but if you develop a good enough sense that, that you want to take that risk, you take the risk. You got to be careful.
Yeah, I'm kind of laughing a little bit because me and Jesse, when it comes to deals and stuff, we go to closing table and we're like, sign me up, we're ready to go. Like, we love doing deals, and we've been confident in our deals. The ones we've done, they haven't been massive or anything like that. So Jesse says we don't have a risk bone, which is can be a good thing, can be a bad thing, but I think that's interesting for sure. I'm curious, do you know two of our friends? So I'm sure one of them but one of the guys' name is Rafiq Moore. Do you know him?
Who is? I've heard of him. Where is he out of?
He's out of, I believe, Minneapolis, Minnesota, but
Yes.
Yeah, I
he's
know
like
where.
the guy who's buying closed down malls as well, and people, kind of think
And
he's crazy for
converting them
doing it.
to industrial.
Yep,
Well,
yep.
he's converting some of it to industrial. Yes, I've
Yeah.
talked to him. Very sharp guy.
He is. He's awesome. And then the other guys, I imagine, strip mall guy.
Yeah, he's
That's
done
cool.
very well. He's got a
Yeah.
great strategy. Got a great buy box.
Yeah, that's cool. That's really
I'm
cool.
the shopping center guy. He's the strip mall guy.
Yeah,
Okay.
that's cool. I feel like I had another question. I guess what would be we kind of touched on it just a second ago, but we like to ask this question. So for people listening, they want to start buying retail. They want to become retail investors. And, kind of asking this from me and Jesse's perspective, everything we bought so far has been industrial. I've brokered a lot of retail, but we've done all industrial. We would love to buy a retail shopping center. So what would be your advice? Somebody wants to go out and buy their first retail deal. And what
Buy
kind
a
of product
small
would it look like?
building. Buy a small building under 10,000 feet, below replacement cost, and just get a sense of the issues associated with it. The 3 or 4 leases you got to deal with. Study the market. That's a good way to get into it. If you need to bring investors in, whether it's family and friends or whatever, that's a good way to get into it. And again, the other thing, you have to try 100 deals to get one. This is a law of large numbers business. Okay, you're generally losing deals. People pay too much. There's something wrong with the roof. Seller is not reasonable. Market's too iffy. It is a law of large numbers.
Yeah. That you reminded me now of my important question I wanted to make sure to ask. So how are you guys finding and sourcing deals? Is it off market? Is it all on market from brokers? Is it a mix of both? Give us how you
It's
guys
a
find deals.
mix, and it depends upon the product type. So in the mall space, there's 2 brokers that are the gatekeepers for 75% of the opportunities, because most of the opportunities come through distressed debt. So the special servicers are required to have a public process. So they go through these 2 guys. The other 25% are, there's some individual deals, and there is some off-market deals, and we've kind of gone that way. In the open air space, most of the stuff is brokered. It's harder to get off market. It can happen, but a seller is going to say, "Look, you're offering X. Let me just list it," and when he lists it, he'll call you, and there's no downside.
Yeah.
For a seller to do that.
Yeah. I think that's a super interesting perspective and something to point out, because depending on asset class you go after completely depends on the whole process. Like, for example, we've been able to find a lot of off-market opportunities in an industrial space, but you have to look at the end, like the person, the seller of an industrial building. I'd say 8 times out of 10 is a guy who bought the building or built the building, ran his business there for several years, long time. Maybe they retired and leased it to somebody and now they're an investor, or maybe they're still there and they're about to retire. So those people aren't necessarily going to brokers. They're mom and pops.
Yeah, they're not used to how stuff is selling, and so you can take an advantage of an inefficiency in the market. Okay,
Exactly.
to get a deal. That's what you can do. I will tell both of you guys, and I'll tell you the listeners, we're looking for deals. Okay, so my email address, and you should put it into Andy Weiner. That's my name, Andy at RockStep.com. My mobile number, call me on my mobile, 832-816-4666. With opportunities, we're looking.
We'll do that.
And then you guys bring us some deals. Shoot, come on.
Definitely will.
Get to work.
For sure.
Get to work.
We will. And to finish kind of what I was saying before, on the retail side, it's investors. Like most of the time, like you're not getting most of the time you're not getting an owner operator retail person. So it's like, I guess what I'm trying to get at is it's more of a sophisticated seller because they bought that shopping center to be an investor. And like you said, they know what's going on. They know what's going on in the market. Why wouldn't they just list it? And therefore they're going to be dealing with a broker. So if you're out there and you want to go start prospecting for retail centers, going straight to owner with mailing, cold calling, yeah, it could work, but most of the deals are going to be filtered through brokers. So that's I feel like a great point to make.
Yeah, and the other thing is that there might be some investors in retail that don't want to go through the pain of learning and the pain of managing because it's painful. And then they can invest directly with a sponsor, whether it's us or other folks. And, if they want to take that route, then, they could look at, coming into our fund, Hometown America Fund One. But they have to like the geography. Some people are big city investors. We're kind of boring cash flow investors. We like to do boring.
Well, cash flow,
simple. We love that.
Yeah. Oh, that's awesome. I think this has been super, super, super valuable. You guys heard where to contact Andy at. He gave his email. He gave his phone number. We'll put it in the description too. If you want to send, and also his YouTube channel. Any last closing comments before we sign off here?
No. Great questions, guys. I love where you guys are living. Find deals. Our buy box. Yeah. And we'll wait that and remember the rock steps. Okay. Remember the rock steps.
Okay. Well, I thought of one last question I meant to ask you earlier. Your airplane in the background, are you a pilot or is that you just like planes?
I love the concept of airplane. I love that's a Constellation. It's a beautiful plane. I love airplanes. I love travel. I love the airline industry. The whole concept of flight. I studied aeronautical engineering in college. I studied business, but I love the concept of lift and how wings work and the whole concept of flight. So it's just a lot of fun.
That's cool. That's really cool. Awesome, guys. Well, thank you so much for listening to this podcast. Go check out Andy, reach out to him, send him deals, send him opportunities. And we thank you again for coming on, and we'll see you in the next one.
Great. Hey, thank you, guys. It's been a pleasure.